Assalamu alaikum everyone. I hope you're all doing well. So today we're going to see the incidence of tax. Incidence of tax is basically the burden of tax which is shared between your consumer and your producer. So we need to know that when the tax is applied, your supply curve is going to shift backwards. S0 is your initial supply curve and S1 will be the new supply curve. You need to remember that the distance between these two supply curves would be the amount of your tax. So here's our demand curve. This is not going to shift. However, there will be a movement along the demand curve. Your initial quantity that was being traded is Q0 and the new quantity that will be now traded due to tax is reduced to Q1. Your initial price being charged in the market was P0 and your new price that is being charged now is P1. As I told you that the difference between the two supply curves is the amount of tax. So this from this point till this point is the amount of tax. We need to know how the burden of this tax is shared between producer and the consumer. So the area of consumer surplus, here's your supply curve, your demand curve, and this will be your consumer surplus, and this is all your producer surplus. The area of consumer surplus eaten up by the tax will be the burden on consumer. This whole area that has now been eaten up by the tax is the burden on consumer, and the area of producer surplus, which is the area below your market equilibrium, below your initial market equilibrium, this area would be the burden on producers. We say this P, we say this C, and due to reduction in quantity traded, this area would be known as dead weight loss. I hope this is clear. Please feel free to reach me in case of any queries. Thank you so much.